All right, all right. I think we're live. Good stuff. Let me go ahead and get the pop on screen for the video or the chat if I could, and we'll see if that works for me or not. All right, there we go. So I'm trying to get the screen for the chat. All right, man, it's gonna be awesome what we're gonna talk about here today, my friends. I'm telling you. Where's the chat thing? All right. All right. You gotta work. See if I can't get this pop out chat. You think after I've done this, I'd have this down pat, but I do not. All right, so you think I'd have this down pat, and I do not. One of these days. All right, one of these days I'll get this. Where's the pop out chat? Is that what I need right there? Pop out chat? Nope. All right, where's the pop out chat? Top chat? All right. Oh, yeah, man, you got it. Pop out chat right there. All right. So, well, there's a. All right, I think we're good. That's a. Where's the? Why is it not showing? Oh, there we go. Sweet. All right, cool. There we go. Looks like we got this. Yeah, you got it. Southwest Iron. He's on here. Hey, Scotland. Will, right on, man. Donald Steer, good to see you all. Actually, I got to close this other one so I can just talk over myself here. 1 second. Blank. Let's close. Which one do I got closed? This guy. I think I got to close this guy. Let's just turn that off. I'll mute that. Blink. There we go. Cool. Hey, thanks. I think we're good. All right. Oh, don't want that one. Want that one. Nope, not that one. There we go. And then I got to get the chat back. There we go. Hey, right on. Dante, we appreciate it for a video. You got it, man. Hey, but so if you ever get a chance, my man Southwest Iron up there, he has some pretty good recipes on Mexican food, on beef marinating. Let me time check, 10:58. And man, love me some Mexican food. I tell you what, right now, I like Tex-Mex. Did not know that authentic Mexican food doesn't use sour cream. At least my understanding from my Mexican friends. Tex-Mex uses sour cream, and I can eat sour cream like it's going out of business. So if you're looking for authentic Mexican food, my understanding is that you're not gonna get sour cream. But if you're looking for Tex-Mex, you will. So just FYI, man, I could kill some Tex-Mex. Oh, it's so good. All right. So we got 10:59. We'll get started here in just a second. And of course, as you all have questions, thoughts, or concerns, put them on there down below. It's gonna be some fun stuff we're gonna talk about here today. Make sure I got everything. Oh, I need my article I want to read from. Where is it? Oh yeah, right here. All right, so we'll go ahead. Not quite yet. Chris Young, man. I tell you what, I appreciate you saying you appreciate it. I love doing this stuff. I'm literally officially addicted. Never got into to dope, but I did love booze, that's for sure. And since I haven't drank any booze since May 25th, 1997, I guess my YouTube is my supplement to my addicted behavior. But I'm a big fan. That's I like doing it. YouTube's I've learned so much from other people. Engineering Explained. Actually, but just talk about Southwest Iron up there. All kinds of people on YouTube. If you're just real quick, if you're looking for help in just running a business, small business, YouTube stuff, Facebook ads, Miles Beckler, milesbeckler.com. The dude's just phenomenal, just a wonderful guy, just tons of good stuff on YouTube across the board. But that dude was a big influence on me. All right, so it's 11 o'clock, so we're going to go ahead and get started here. This is the primo tax time. I'm telling you, I cannot stress enough. Hey, thanks, Will. Yeah, right on. Will says he appreciates my Vanguard stuff. I'm a huge fan of Vanguard. I had a guy the other day, just real quick, just talking about he was kind of down on Vanguard. I can't remember the guy's name, and I think I actually came across a little bit not hostile, but maybe a little bit. His whole issue is he has some customer service stuff, and man, I look, I get that. I come from USAA, which is notorious for having great customer service. But yeah, I'm telling you right now, not every time you call USAA do you get great customer service. I just think corporate America has an issue with customer service across the board. It's just no getting around that. So, and when you're farming out your IT to India, or when you're farming out your customer service to contractors who aren't full-fledged employees, I generally think that could have an impact on customer service. No idea if Vanguard is doing that. No idea if Charles Schwab is doing that. No idea. Let's just put it this way. I do know for a fact other firms are. And when you have a customer service that is not, what's up, Monty? From Garland, Texas, right on. Monty, Monty's checking in. I just think if you're expecting great customer service from a large firm across the board, I think you might want to look at your expectations a little bit differently, which is a problem. That's no other way around that. All right, so let's talk taxes. All right, so and I did a video on this yesterday where I was telling you about Fidelity FDR GX, FDR, like the President GX, Golf X-ray. And I was just using that for an example because this woman had 48,000 shares of FDRGX, and it's going to pay about $1 a share in long-term capital gains. And that's thankfully is long-term, not short-term. But that right there is $48,000 she's going to get as taxable income. Now, I think I said this fund I was using I think it was a 2% dividend for proxy. I don't think that fund actually has much. I can't remember, but I don't think that fund specifically had much of a dividend. But generally speaking, if you have a large cap U.S. stock fund, you're going to get roughly 2% as dividends as well. So in her case, she had, let's say 48,000 shares. Okay, just in the future, can you do a thing on two-way HELOCs to help pay off a mortgage? Yeah, at some point, sure. So she had $48,000, 48,000 shares, and it was paying a 2% dividend. So she's going to get roughly, I think I said $20,000 in dividends plus $48,000 in capital gains. So just that fund alone was going to give her a roughly $70,000, $80,000 income stream. Can't really do much about the dividends, but you can do something about the long-term capital gains. Now, long-term capital gains are taxed at 15% or 0, depending on your tax bracket, or 20, or even up to 23.8 if you're subject to the Obamacare surtax of certain income streams. I think if you're single, it's $200,000. If you're married, finally, jointly, it's $250,000. So if you have net investment income tax, and I actually write about that in my book, shameless plug for my book of the tax bomb in your retirement accounts. If net investment income tax, if you have an income threshold above 200 single and 250 married, filing jointly, you pay the Obamacare surtax, which is 3.8% on your investment income, dividends, capital gains. And so her case, we're not worried about that, but she is going to have $48,000 of capital gains, all right, and then X amount of money for dividends as well. Now, the problem with capital gains is that if they're short-term capital gains, you're paying ordinary income taxes, but ideally it's going to be long-term capital gains, and most should be. The problem with that, though, is that that's going to flow to your bottom line. And so if you have, going back to the net investment income tax, going back to modified adjusted gross income, these things are what your Medicare premiums are based on. These things are what your Social Security taxes are based on. These things are what your tax brackets are based on as well. So I'll give you this lady's example. Let's just say she has $50,000 in capital gains, $20,000 in dividends, and then she has Social Security on top of that. All right, so you factor all this stuff, and we're starting to look at a tax bracket that is much different than if she didn't have those capital gains. And then you start to look at all this thrown in there, and she's going to potentially have not only more taxable Social Security taxes, which may or may not have been subject to no income tax, but she'll certainly have potentially Social Security taxation. She'll have more taxes or premiums on her Medicare as well. And if we just look at your Medicare thing right here, this is your 2018 Medicare cost. Your Medicare Part B premium, if you're single and your tax return is above $85,000, is modified adjusted gross income, you're going to pay an extra premium on your Medicare. All right. So that's single taxpayer. And this isn't after standard deductions kick in or itemized deductions. This is just straight on Medicare. If you have more, I got a call coming in, sorry. If you have more income over $85,000, modified adjusted gross income, and that's modified adjusted gross income is everything to include your tax exempt interest before your standard deductions kick in. And so in this lady's case, it doesn't take much to get above that threshold where she's going to pay more in Medicare premiums. And then if she has over $133,000 of MAGI, her premiums are going to triple. And again, that's real money. That's real money from what? From just long-term capital gains, short-term capital gains, or dividends that has come down to her from her mutual fund holdings. Now, in this case, there's nothing she can do about it because she can't, I mean, she could, but it'd be stupid to sell the FDRGX because she has pretty significant capital appreciation there. So she, let's say her cost basis is $500,000. It's worth $1 million. So she has that $500,000 difference between her cost is what if she sold it, that she'd have to pay tax on that, and what the account is worth at that time. So if she were to sell that puppy, I mean, she's now got $500,000 of capital gains. You can't have that. So what's the solution? Well, the solution is to start scouring through her investment portfolio and find anything that's got a negative behind it. If it's got a negative behind it, we start selling those puppies. And I frankly don't care what the holdings are. In one case, it was a Calamos fund. I think it was a Calamos Growth and Income Fund, which is a great fund, but it has a negative behind it. And so we're selling it in order to take some of those losses off to offset some of that $48,000 of long-term capital gain. And I think she had $21,000 of negative of losses on the Calamos fund. So we're selling that guy, and that $21,000 will be offset. Well, that $48,000 will be reduced by the $21,000 of Calamos Growth Fund. So right now, was that the $27,000 will be her long-term capital gain. And so right there, just from doing that alone, it saves her money on the tax consequence, but also saves her money on Social Security taxation, and also saves her money on premiums on Medicare. And ultimately, it'll get her below the income threshold to remain in the 12% tax bracket, so her capital gains are not taxed at all anyway. I know that's a lot to chomp on, but we'll talk about some strategies. But remember, if you have a mutual fund and it's getting ready to pay a distribution, I'm going to share with you some examples here, and that mutual fund pays you a distribution and you haven't done anything, it not only will affect the taxes you pay on that distribution, it'll affect your tax bracket. It will increase potentially the taxes you pay on that distribution, because presumably that it might not have been taxed at all. If you stay in the 12% tax bracket, now you get a large distribution on a mutual fund, you are now going to pay 15 cents on the dollar, where before you wouldn't have paid anything because your tax bracket has gone up. It'll affect your Medicare Part B, your Medicare Part D, and it's going to affect your taxes on Social Security as well. And if you're a single taxpayer, it doesn't take much for all this to happen. So remember, if you're a single taxpayer and you have over $38,000, is it $38,000? I always forget this. I think it's $38,000 to be a single taxpayer will put you in your the next highest tax bracket. I'm looking at my books. I got the tables in here. Yeah, right here. So if you have over $38,700 of taxable income, so that's before you take your standard. That's after you take your standard deduction. So basically, if you have $50,000 of gross income as a single taxpayer, you're now in the 22% tax bracket, which means you are now paying taxes on those capital gains, qualified dividends, right? You just can't have that happen if you have offsets to avoid it. So let me give you a couple examples. And I found this article today from Advisor Perspectives, which is they had sent me this article right here. Q4 silver lining, plenty of tax loss harvesting opportunities in 2018. All right, so in 2018, this is from, who is this from? Who had written this? I can't remember the firm, but I get it from Advisor Perspectives. I get emails every day about their new stuff, and I talk a lot about Advisor Perspectives on my video channel here. A guy named Joe Tomlinson is on there. Who's a couple other guys? Obviously, Wade Pfau. Man, I'm drawing a blank. Joe Tomlinson, Wade Pfau, Gunlack. I forgot his first name. There's another guy I'm thinking about. I'm drawing a blank on it. So anyway, a lot of these guys I follow. Anyway, so here we got this article I got today from a CFA out of, I'm not even sure what firm he's with because my printer sucks. But anyway, he says, no one likes to see a broad sell-off across asset classes, but investors can still make most of the situation by considering tax loss harvesting opportunities heading into the year end. Tax loss harvesting involves selling assets in a portfolio that are below your cost basis. Thereby realizing capital losses that can offset capital gains in other positions of the portfolio. Back in 2017, tax loss harvesting proved to be challenging because all asset classes has strong performance. Let's see. In such a bullish market, investors can potentially receive higher than expected tax bills in the following April as ordinary turnover in their portfolio through rebalancing or tactical or strategic asset allocation happens and recognizes realized capital gains. This year, however, may be different. Rising interest rates, heightened geopolitical tensions, and slowing global growth have combined to pressure virtually all major asset classes into negative territory for the year. Investors would be wise to speak to their financial professional or just do it yourself to take advantage of the broad sell-off by realizing losses and adjusting their portfolios for 2019. And so it gives us a chart of the various asset classes that are down through the year. And so let me give an example. I used when I was at USA, it was USIFX, I think. What did I write down here? USIFX is a USA international fund. Very fast paced. I talk fast, my friend. I talk fast. I don't know why. It's just the nature of my beast. Maybe I'm nervous. It's a nervous habit. You know, if you ever hear these bands, they go up on stage when they're live, they play faster than the studio recording. There's a nervous thing when you're live. You talk faster. Drummers play faster. Guitarists play faster. I guess that's what I'm doing here because this is a performance to some degree. All right, so USIFX, the USA International Fund, is down 13.23% so far year to date. 13.23 as of close of business yesterday. If you own that sucker outside of an IRA, you should sell it without question. You know, obviously, I don't know your situation, and you'd lock in a 13.23% loss for the year. Now, I don't know what your cost basis is. You might have bought this in 1921, silly, but you might have bought this a long, long time ago, and so your cost basis might still be higher or lower than what your net asset value is today. I don't know. But if you just bought this puppy at the beginning of the year, you're down 13.23. The USA Emerging Markets Fund is down 19.44%, my friends, year to date. 19.44. I have a sneaky suspicion if you bought the USA Emerging Markets pretty much any time in the history of the mankind, you have a loss in that portfolio. You'd be highly encouraged to sell that puppy to lock in those losses. And I'm going to share with you why here more than just a Fidelity fund here in just a second. So I looked up a VWO. I couldn't get a gauge, and that's a Vanguard Emerging Markets ETF. I didn't look too far at it, but I couldn't get a gauge of what that is. But USA Emerging Markets is down 20% roughly. Certainly VWO would be down a similar amount. USA International Fund is down 13%. Certainly other international funds are going to be down pretty in double digits for sure. So the extended market index, that's the S&P 500, or that's the Wilshire 4500. That's domestic stocks now. So the Wilshire 5000 is a total stock index. You take out the 500 stocks from the S&P 500, and you're left with the Wilshire 4500, which is the extended market index. It's basically everything in the U.S. stock market minus the S&P 500. That guy so far this year is down 4.33. The Vanguard small cap index is down 3.77. So you can see here, the Vanguard total stock index is only down 0.33, but you can see that everything is down except so far for large cap domestic stocks, which is the S&P 500, which as of year to date, as of yesterday, was up 0.33%. So you'd be highly, highly encouraged to go through your portfolio, find those positions, international, emerging markets, small caps, and just liquidate them. And again, I don't know what your positions are. I don't know what your holdings are. I don't know. But if you have losses in there, sell those guys to offset the gains that are coming. And how do I know gains are coming? Well, because if you look at the Vanguard year-end distributions, I talked about Fidelity yesterday, The Capital Opportunity Fund, for instance, is going to have about 9.5% of the portfolio will be distributed as a long-term capital gain. I don't know if y'all can see that or not, but that's the Vanguard right there, Capital Opportunity Fund, and you can see right there the percentage of NAV right there, 8.94. This was as of the other day. This is as of, I think, the end of October, I think. I can't remember. But this, the markets have since sold off even more. So as of today, this guy is going to distribute $6.44 in long-term capital gains. And I can't remember what the portfolio is trading as. Trading at $67. So this is going to distribute almost 10% of the entirety of the portfolio as long-term capital gains, which means if you have $100,000 in this guy, you're going to get a $10,000 long-term capital gain distribution coming at you, even if the portfolio was down this year. And I think it was down it's up this year, 1.34%. So let's just use this for an example. You have the Vanguard Capital Opportunity Fund, the investor shares. It is closed to new investors, by the way, so you got to be careful because if you sell it, you might not be able to get back in. But anyway, it's trading right now at $67.39. It is up so far the year, 1.34%. It's going to have a long-term capital gain distribution of 6.44, most likely. That is estimated. We don't know exactly, but roughly $6.44 per share. All right. And so you simply take the I'll write it here. Well, I don't know if you'll be able to see this or not, but I'll show you how you figure this out and why it's so important to understand how this works. You take the 67.39 and you divide by 6.44. So this is what you do. And hopefully you can read my crazy writing. 67.39 is the price per share as of yesterday. You divide by the amount that they're going to distribute, 6.44, and you're getting basically a 9.5% distribution amount. And I'm just going to round up and say 10%. And what that means is for every $100,000 you have, $10,000 is coming at you as long-term capital gain, taxable as long-term capital gains. It doesn't matter when you bought it. It doesn't matter anything. It doesn't matter what the portfolio has done so far. Again, this year is up 1.34. It could be down. It doesn't matter. It doesn't matter. You're going to get that distribution, and you're going to pay tax on it. And going back to my lady with a Fidelity fund, so you're going to pay tax on it, which could affect other aspects of your tax planning as well. You got to find your losses. And the way to do that is to go through your portfolio and look. All right, so let's look at some other asset classes. Emerging market stocks are getting hammered. European stocks are getting hammered year to date. Asian stocks are getting hammered. Asia ex-Japan. Japan stocks are getting hammered. U.S. small caps are getting not hammered, but they're down about 4 to 5%. Preferred stocks are down about 7.5% so far as of November 21st. So we still are going to get it's much worse today. REITs are down about 2%. Inflation protected bonds are down about 3%. Gold is down 5.3%. Commodities, everything is down except large cap U.S. stocks, which is basically squeaking out 1/3 of 1%. This is as of November. So by now it's probably even down more. So go through your portfolios and find out what you have to sell and sell them. My goodness. You got $100,000 of capital gains. You got $50,000 of capital losses. There's absolutely no reason not to take that. Sell that sucker. I mean, again, I'm just going to put it back on you. Don't put it on me. Put it back on you. Now you've reduced your capital gains by $50,000. All right, let's just say you have $40,000 of capital gains. You got $70,000 of capital losses. You sell that puppy. Now you get $30,000 capital loss carry forward. Now, $3,000 of that can be used against ordinary income in this year. All right, so now you have $30,000 of capital loss carry forwards, of which you'll pull $3,000 out to offset your income. You still have $27,000 that you can use in the future, either at a $3,000 capital loss clip against income over the next 9 years, or in one fell swoop, however you want to do it. But you're locking in these losses to be used in the future. They are an asset, my friends. Capital losses are an asset. Now, what if you really like the holding? You're like, man, Josh, you're dumb. I don't want to sell that. I'll make sure I got nothing else here. Okay, good. What if I really like, I don't know, well, what's down here? VWO. All right, bought the Vanguard emerging market ETF. I really like that. And I don't want to sell it because I'm down 20% and I want to come back. sell it, man. If wait 30 days. After 30 days, you offset what's called the wash rule, where you can get back in. Is it really going to pick up? You know, if it's down 20%, it's got to be up by 25% to just break even. Do you really think the VWO is going to pick up 25% between now and 30 days time? Now, if you do, fine, more power to you. It's just, when does that ever happen? I mean, when have we seen a 25% increase in in any kind of position other than an individual stock in 30 days time? The answer is not very often. And so it's just not going to happen. And so you're sitting there thinking, okay, I like VWO, I like emerging markets because they're priced favorably relative to the price and earnings ratio of the US. I'm going to sell it. I'm going to take the loss. Oh no, I just locked in a loss. Okay, but I really like it. Well, lock in that puppy and go back 31 days hence to avoid the wash rules. What a wash rule means, my friends, is if you sell something in order to take the loss and then buy it back before 30 days are up, the IRS says you can't do that and still maintain that loss. It's basically like it never happened. And so the IRS doesn't let you do that. So in this case, you're saying, no, I don't think that it's going to come back within 30 days from where I initially bought it. So I'm willing to take the risk that it doesn't. Part two of this, actually, and this is just another tangent, there's lots of studies. In fact, I'm going to look at one. I can't remember where I found it. Is I have a piece of paper, article I was looking at, was it today or last night, about the momentum play. Momentum is simply ride your winners, cut your losses. I mean, there's something called momentum investing, and I actually own a fund on that. I probably shouldn't say the firm, but I own it for fun on that because I believe in momentum investing, actually. And I own a fund as an ETF that focuses on momentum investing, where you're buying or you're selling your losses, you're cutting your losses and riding your winners. And that's what you're doing here. And I'm just picking on VWO. You're like, look, man, you're down 20% of the year. I'm cutting you, and I'll get back on you next month if I want, or I won't, but I'll wait for it to start seeing some momentum, because just because it's down 20%, doesn't mean it can't go down another 20%. I'll give an example. Small cap stocks, it was in 2013, and emerging markets 2015. Both of those are down in the middle of the year, and deep bear market. And I can't remember. I remember emerging markets were down like 35%. I think it was in the beginning stages of 2013 or 15. I forgot. But both those puppies were down big time in a 6 to 8 month time period, man. But no one sold them because everyone waits till the year end, like we're talking about here. And if you were paying attention, you could have easily sold those probably in August, locked in losses that you probably could still carry forward today. You've got to take your losses when they're given to you. And right now is a wonderful, wonderful time. All right, so let's keep talking about this, because not only can you take your losses to offset gains, remember, these are non-IRA, non-401k, non-403b accounts. It doesn't matter. 403b, IRA, TSP, 401k, none of this is applicable to you, because everything that comes out is taxed as ordinary income. Secondly, when you're looking at your account statement in a 401k, one of my pet peeves is that it doesn't give you a true cost basis. It simply does not. Your cost basis in a 401k and IRA is zero. It's just zero, because every single penny is coming out taxable. So you look at it and you're like, oh, I bought this for $100 and now it's trading at 101, but I have I'm down in but it says I've a loss in the portfolio. I'm telling you right now, if you look at your portfolio online on your statement and it looks like you have a loss, it doesn't mean anything. A, because you can't write it off, but B, what happens in a fund and an IRA is that when they send dividends and capital gain distributions, that will be used to adjust your cost basis in the portfolio under the assumption that those dividends and capital gains distributions were taxable to you as income. Well, they're not taxable to you as income. And so I'll give an example. I'll use my chart here again. If I can find my little, hold on just a second. There I go. I'm going to show you how this works, because I get this all the time. All right, so I got $100. I invested in, we'll just use VWO, $100. So I got $100. I invested in it. All right, that's my cost basis. That's what I invested in it. It pays a $5 dividend. So now my cost basis is 105. All right, so basically I got invested in VWO and paid a $5 dividend. So I got a cost basis of 105. I look online and it's down to 103. So VWO is at 103. All right. So I bought it for 100. It paid a $5 dividend. My cost basis is 105. And now I look at my online, it says it's 103, and it says I am down -2. I'm down $2 per share. The reason being for that is because it assumes that $5 dividend was added to my $100 cost basis, which made my cost basis 105, which simply means that because it's only trading at 103, I have a $2 loss. But you don't have a $2 loss because what did you buy the fund for? You bought 100, you bought it for 100. The reason it says you have a cost basis of 105 is because it assumes you pay tax on that $5 per share dividend. But you didn't pay tax on that $5 per share dividend. It's in a 401k. It's not taxed, so it comes out as ordinary income. And so if only in the financial realm that we deal with, if you have $100 as your true cost basis, your purchase price, and it's worth $103, would they say that you have a loss? You don't have a loss in that portfolio. You have a $3 gain. I mean, that's just all there is to it. So you bought for 100, as a $5 capital gain distribution or dividend, doesn't matter. The model assumes that your cost basis goes from 100 to 105. If the portfolio is trading at 103, it says you have a $2 loss. Well, you do have a $2 loss in a taxable account, but you don't have a $2 loss in an IRA. And for the love of me, I don't understand why all these smart engineer types, these fancy schmancy guys with their PhDs in computer science can't figure that out. It's an IRA. There's no loss there. All right. So don't look at your portfolio statement and say, oh my goodness, I got a loss. I cannot tell you how many times I had that happen to me. Guy looks up his account from the S&P 500 and says, I've lost money. I'm like, how? He said, because look, I have a negative account balance, or not negative account balance. I got a negative sign on there. I said, how much did you invest? 100,000. How much is it worth? 120. How have you lost money? Well, why is USA or Vanguard or Schwab showing me that I got a negative? I have a negative. It's worth less than what I put in there. I say the reason it does that because it assumes the cost basis increases in your IRA portfolio based on things like dividends and capital gains. That drives you up the wall. All right. So what else can we do? All right. So let's say we have big capital losses that we can sell. What does that do for Roth conversions? All right. So remember now, you can't offset capital losses with just regular income. It doesn't work like that. You can only offset capital losses with capital gains. But let's just say you're thinking about doing some Roth conversions. And we'll use my lady, for example. She has $48,000 of long-term capital gains. That's in a taxable portfolio, a taxable account. What if we say, you know, Mrs. Lady, let's go ahead and convert $50,000 from your IRA to a Roth? And she'd say, that's crazy talk, Josh. I don't want to pay an extra tax on the capital gains, the dividends, and then on top of that, my Roth conversion. I said, well, we're going to get rid of your capital gains because we're going to sell portfolios that have lost money. In this case, a Calamos Growth and Income Fund to offset that. So your $50,000 capital gains are disappeared by $50,000 of losses. So that means only you're going to have to do now is you're going to have to pay tax on your Roth conversion. That's fact. No getting around that. But at least you don't have to pay tax on the dividends. I mean, the capital gains, because we offset those with your capital losses. Now, also people say, what about Obamacare premiums? Well, I agree with that too. You get Obamacare subsidies. You got to be careful there as well. Your Obamacare subsidies will be, you'll lose some Obamacare subsidies if you have massive gains in IRAs, but if you have massive gains in capital gains or dividends. So if you have those massive gains, you can't offset it with other things, you could potentially lose Obamacare subsidies. And another reason why you want to lock in your losses to offset your gains for all this stuff. Your Obamacare subsidies gives you more benefit for Roth conversions. Doesn't affect your Social Security taxation, doesn't affect your Medicare premiums, won't allow you to go from a 0 tax bracket to 15% for capital gains, long-term capital gains and qualified dividends. So many reasons in which to do capital tax loss harvesting that I just don't know why more people that don't. And don't just wait till the end of the year. All right, so I've got a couple questions here. And recommendations to newer investors that have only contributed to target date mutual funds. Tax planning, if you don't have any investments, there's no application here, my friend. That's why I have an IRA, says my man Monty. Am I familiar with cryptocurrency tax laws? I'm actually not. Currently, the IRS considers them property and not security. If I sell at a loss, I don't know. That's a good question to look at, my man Joe. So I don't have any gains this year. Can I still deduct a loss? You can always deduct $3,000 off your ordinary income. That's a fact. So if you have a loss, you can deduct $3,000 and no more. Heaven forbid we inflate that with inflation. That'd be crazy talk, right? Because there's no way we can keep track of adjusting your cost basis if we index it for inflation. All right, so let's also talk about, ETFs versus mutual funds. All right, so ETFs are taxed more favorably. That's just all there is to it. ETFs, most likely, not all of them, but most ETFs, exchange traded funds, will not have dividend, or I should say will have dividend, but they won't have capital gain distributions necessarily. I mean, some may or may not. But the reason for that is simple, because an ETF, at least an index fund ETF, doesn't have a high turnover. There's not much trading going on. So there's not much trading going on, not much activity in which to sell a gain, of profit, and to basically mess around with your account. There isn't going to be much taxes to be paid from an exchange traded fund. But even more importantly than that, let's go back to the lady I was talked about, Mrs. Smith. If she were to sell part of that Fidelity Growth Fund, she's calling Fidelity and says, "Hey, Fidelity, this is me, Mrs. Smith. This crazy guy on YouTube told me to sell this," which of course I didn't. But anyway, just this crazy guy on YouTube said to sell my portfolio because I wanted to lock in a loss. What does Fidelity have to do? Well, they actually literally have to liquidate shares. They have to liquidate shares when they have redemption requests. Now, in this case, in Fidelity's growth fund, 58% of the portfolio is appreciated assets, meaning that those assets have yet to be taxed. So if she were to sell and send a liquidation request to Fidelity, they don't have much they can work with. They're going to have to sell a position, most likely, that is taxable to their other shareholders. And that's how mutual funds work. With an ETF, it doesn't work like that. And that's why we have premium ETFs and discounted ETFs, because the price isn't, well, it's attached to the S&P 500 or whatever it is. There is some fluctuation there because it's based on the net asset value. So it's like you're selling a stock. You're basically selling a stock based on the demand and the supply of the market shares. It's not so much based on the actual holding. What happens is they don't have to redeem shares in which to make you whole. It's like when you sell a stock of AT&T, you sell AT&T stock, you go to the market, you're not saying, AT&T, I'm selling my stock, cash out my shares and send me a check. It doesn't work like that. You're just saying to the market, I'm willing to trade my shares. I have 100 shares I want to sell, and you have 100 shares you want to buy. So I'm asking, this is where the bid-ask price comes, like I talked about yesterday. I'm asking for $10 a share to myself. That's my ask. Someone's saying, I will bid you $9.95 for those shares. And then we got to come up with it. But it has nothing to do with AT&T. It's got nothing to do with it. Not liquidating shares, removing them from their treasury. Nothing's happening. The number of shares outstanding still exists. Same thing with an ETF, for the most part. Is they're basically saying, I'm finding a buyer for the shares I want to sell. Has nothing to do with the ultimate holdings in terms of what happens with the taxes due to everybody else. Hope that makes sense. There's a lot going on with the ETFs. I think is way, way, way undervalued when it comes to the difference between an exchange traded fund and a mutual fund. When you are selling positions on an exchange traded fund, you are not being a burden to all the other fund shareholders. You're not, because those shareholders do not have to pay taxes on your distribution. They don't. If you are selling a mutual fund, Fidelity Growth Fund, and I'm selling my $1 million position, and I'm saying, hell's bells, I'll take my $500,000 capital gain because the new guy who runs Fidelity is crazy. He went to the University of Georgia as opposed to going to Georgia Tech, and now go Yellow Jackets, hell with Georgia. That's what the Georgia Tech fight song is. I literally just learned that this year. It's pretty funny. And Georgia has the same thing. It says the hell with Georgia Tech. Who knew? But anyway, I thought in the South they're supposed to be polite. But anyway, so when they're selling their funds, they literally have to go in there and sell the shares that back those funds up, because it's an open-ended mutual fund. And that's a big deal. And if you got a mass redemption because, I don't know, some Warren Buffett type hedge fund guy owns 10 million shares of it, that's going to affect you, even if you're just Joe, Pitten's only got 5,000 shares. You're going to get hammered. And that's the way it works. With ETFs, it doesn't. That's what we just talked about. And you want to have ETFs, and they're going to be typically a little bit less expensive, but you can control the capital gain distributions, and you can't in the mutual fund. And just going back to Vanguard Opportunity Fund, Capital Opportunity Fund, 10% of the portfolio is going to come at you this year as long-term capital gains, regardless of whether or not you bought the shares with a gain, regardless of whether or not you want the gain. It doesn't matter. If you hold the shares, again, I think it's on the the date of declaration, I think that's what it's called. X date is the last day you can get rid of it without being held responsible for the taxes. Declaration date, dec date, is when whoever owns it that day is going to be responsible for the taxes. My man Monty from Garland, Texas says, what do I think about American funds? Man, I love American funds. Always have, always will. I will take American funds any day of the week, even with a 5.5% upfront commission over some guy who's managing my portfolio for 1% a year in the low-cost Vanguard ETFs. I'll take it any day of the week. I'm just telling you right now, it's a matter of arbitrage. If I'm paying American funds 5.5 on the front end on my seed, and I'm only paying 0.45 every year thereafter on the bounty, and you are paying 1% on the front on the seed and 1% on the bounty as it grows, I will take American funds 100 times out of 100 simply because I'm going to outperform you most likely because the fees are lower. And the guy who's managing money in an RIA, they're so smooth, so righteous, registered investment advisor, he's only using Vanguard funds, but man, he's charging 1%. There's no way in the long run that guy's going to be able to say, I can do better than American funds because I don't charge commission. It's just no way. I would think I think you would dig Bitcoin principles, the community, most libertarian. Yeah, I get it. My man James Altucher, who I follow on his podcast, he has a free tutorial on Bitcoin and cryptocurrency. I haven't taken him up on it. A lot of people ran him. They say he's trying to sell something. He's not trying. My man James, a wonderful podcast host. James, I don't know him. He doesn't know me from Adam. James Altucher podcast. So he talks about crypto, Bitcoin quite a bit. And he has a free course on it. I have no idea if he gets solicited. I don't know, but I've listened to James every time he does a podcast. It's on the background noise for sure. So James Altucher, I'm a big fan of. Who's the guy from the Survival podcast? Vin Armani, I think. He talks a lot of it. And I just haven't gotten into it deeply enough, Joe. Joe's just asked about cryptocurrency and Bitcoin and things. I just at this stage, it just hasn't interested me enough to fall into it. I imagine at some point I will. Thoughts? T. Rowe Price, Phil Libre. I got no problem with them out of Baltimore. Just at the end, and I actually did a video on T. Rowe Price funds and their online stuff. At the end of the day, T. Rowe Price is going to get lost in the shuffle. It's going to be because they're more expensive than its competitors in Vanguard, Fidelity, and Schwab, and they just don't have the footprint. So it's hard to see T. Rowe Price. It's just hard to see survival in this. And I mean, look, they can get by on charging 95 basis points on their funds for quite some time. But at the end of the day, man, and like someone had pointed out on the Fidelity Growth Fund, that's 85 basis points, and that's relatively cheap relative to the overall market. But those days are turning very, very quickly. You're not going to get away with charging 85 basis points. You're just not, and you shouldn't, because you're not warranted that. In this case, with T. Rowe Price and Fidelity charging that expense, I mean, they got so many legacy investors who have huge capital gain. If they were to sell, no one's going to sell it because they can't afford the capital gain hit. And so because that T. Rowe Price, the old Fidelity mutual funds, they're being replaced as we speak with ETFs. Now, American funds are different. American funds charges about half of what Fidelity charges, but they do charge a front-end commission because they're paying a distribution channel, Edward Jones. I don't know if the big brokers, wirehouses use them anymore. I don't know. My presumption is they probably are. American funds is probably the one firm that will still maintain itself just because their track record is impeccable and because they charge a whole lot less on an annual basis than T. Rowe Price does in Fidelity. It's going to be hard for those firms to stay in business, in my opinion. I don't know. I mean, I'm sure they're making more money than I am making. I guarantee you that. Mr. T. Rowe Price, whoever that guy is, I guarantee he ain't a pauper. The Johnson family at Fidelity, they're worth 20 to 25 billion bucks. I guarantee they got some chops that they can they can hire some freaking hoodlums out here and take me out tomorrow if they want, and no one would be any for the wiser. And I'm not saying they're going to do that, but just at the end of the day, those guys are not going to be destitute anytime soon. So don't feel bad for the Fidelity or T. Rowe Price. Fidelity has definitely changed relative to their offerings in terms of they have all these offices, whatnot out there. Definitely have a big 401k plan. I think T. Rowe Price I don't know how they're going to compete. It's economies of scale. Vanguard, same way. I mean, at some point you get such large enough, you can essentially take a loss leader. And this is what Fidelity is doing on their free ETFs. I mean, they have these ETFs they don't charge you a penny for. It's loss leader. No getting around that. And it makes sense. I mean, they're invited. If you ever go to a bank, banks will say, we got a teaser rate CD. Why do you think they do that? They're doing that because they want to generate money, but they want a chance to solicit you. They know for a fact they do not call it. They can't just call you out of the blue and say, hey, Mrs. Jones, we're having a sale on CDs. It doesn't work like that. They've got to get you in as a customer. Then they can solicit you, do the blue in the face. And what happens is here, they're going to put Miss Jones goes to the bank, saws that, teaser rate on a CD, or sees his teaser rate on the Fidelity ETF or free expense ETF accounts. And next thing you know, you're getting called and say, hey, Mrs. Smith, forget that 2% CD. We got a guy on our platform can talk about a fixed annuity of 3%. Or Fidelity call you up and say, hey, Mrs. Smith, forget that 0% index fund. We got Peter Magellan has come back, or Peter Lynch has come back to manage a Magellan fund. What do you think about that? It's what's going on. I don't have a problem with that. I mean, USA does the same. They're advertising all over the place. If you're a veteran, honorably discharged, you can join USA. I mean, why do you think they did that? To grow the firm in terms of membership so they can solicit more business. I don't have a problem with that. Just remember, none of these guys are altruistic. They're all for the bottom line. And if you think that's not true, you're crazy. Just remember that. So with T. Rowe Price, I got no problem with them. I was going to say at the end, and that kind of goes back to Vanguard, the T. Rowe Price, USA, Fidelity, Charles Schwab, all those firms. I don't know if T. Rowe Price does. Fidelity, USA, not so much though. Vanguard, no, not so. I think about the sales forces. So Charles Schwab, TD Ameritrade, and Fidelity all have sales teams out there soliciting business. And if you look at like Tony Robbins, he's now with Creative Planning. Not now. He's been with quite some time. Creative Planning is out in Kansas, and Tony Robbins is essentially their spokesperson. And they have real tight relationships with the Schwabs of the world and the Fidelities and whatnot, in TD Ameritrade, in order to get the Schwab and the Fidelity and the TD Ameritrade sales force to identify opportunities that they can bring on Creative Planning as a registered investment advisor to do business with them. Again, I got no problem with that model on the lease, as long as you as a net end consumer know what you're buying and why you're buying it. I don't have any problem with it. All right, so tax stuff. I just want to go back to tax stuff. Roth conversions have to be done by 31 December. So if you're looking at Roth oh man, I wish I would have printed off a 1040. Yeah. All right, so I want to real quick, and I can yap on this like the best of them. How long have we been on this? Man, I've already been yapping for 43 minutes. Oh yeah. When it comes to yapping, you're looking at the Yap Kid here. I should call myself the Yap Kid. Maybe that's what I'll change my YouTube channel to. Yap Kid channel. All right, but anyway, when it comes to your 1040, I was dealing with a lady in New Hampshire or Maine, something like that, a couple years back. Oh, it made me so mad. Nicest people in the world, salt of the earth. I don't want to say a whole lot more. Let's just put it this way. When I asked for the 1040, they kind of were taken aback. Like, why do you want to see my 1040, old buggy? And I said, because we got to see what kind of taxable income you have so we can see if Roth conversions make sense. Long story short, she had no taxable income. Oh, my goodness. She had losses on her portfolio. And not her portfolio. She had net losses on her tax 1040. Why, for heaven's sake, were we not doing Roth conversions, or at least just taking mass distributions from her IRA while she had negative income? For the love of me, blame the tax guy, blame the financial advisor, blame her lawyer. I don't know. Blame everybody. Blame her. I don't care. If you have a 1040 and I don't have one, how do I not have a 1040 sitting right? I got all this stuff up here and I don't have a 1040, for the love of me, man. It was line 37. I don't know what's going to be next year, but if you have negative income, If your adjusted gross income, line 37, is a negative number or a zero, or if you go to your taxable income, which is line 43, if that's a negative number or zero, and you're not doing Roth conversions or taking money out of your IRA, you're wrong. You got to be doing that stuff, my friends. You got to look at your 1040, for heaven's sake. If your financial advisor is not looking at your 1040, you get a new one. And I don't really care where. I'd ask, what do you do? And if they don't volunteer, they look at your, if they just say tax planning, well, I'd ask, what does that mean? And if there's got to be more than just tax loss harvesting, because tax loss harvesting is easy. Everyone does that. Oh, Mrs. Smith, I see it's, you got 15% down in your VWO this year. Let's sell that and we can offset to buy something else. That's easy stuff. That's the easy thing. Brokers do that all the time. It's got to be more than that. In July, you look at your portfolio, you're down 44% in stock. What just got hammered? GE got hammered. So you're down 44% GE. Why would you not sell that, man? Sell that sucker in June. Don't wait till December. Do it in June. Lock that puppy in for later so you can plan. Look at your 1040, the bottom line 37, 43, and 44. 44 is the actual amount that you paid in tax. You paid zero. If you paid zero, why are you not pulling money from your IRA? Why would you not do that? If you paid $1 million, billion, $1 trillion, have you done it because you have losses in your portfolio you have yet refused to sell and you got huge capital gains? I don't know. I keep looking for my 1040. A financial planner without this guy right here, without a 1040, is naked. It's like I had no clothes on, which is kind of embarrassing. So make sure that you find your 1040 and look at it. And then you can make at least some estimate what it's going to look like next year based on the current position that you are today. Now, remember, next year will be different on a 1040. Next year being 2019. This year will still look the same. Is it this year? Yeah, this year, right? It'll still be the same. The Obamacare tax is gone next year in 2019. I think 2019 is when the new 1040 comes out. I don't think it's this tax year. I think it's next year. I do know next year the Obamacare tax is gone. For the mandate, I know that's gone. That's a big deal too, I will say. And next year will be the new 1040, I think. So if it's line 37 for 2018, 44 to 43, those are the numbers you want to look at. You want to look at your Schedule A, is that itemization. Schedule B is your interest. Schedule C if you're self-employed, and Schedule D is your capital gain. You want to look at your Schedule D. Do you have capital loss carry forwards that you can use to offset capital gains this year? It'll happen automatically if you do, but at least you can be proactive in recognizing, oh man, I got $100,000 capital loss carry forwards. I'm only taking 30,000 capital gains this year. So let me go ahead and sell some stuff to offset. Maybe you have a holding that you don't want anymore. Maybe Elon Musk has really ticked you off for smoking dope with Joe Rogan. I don't know. You're like, I don't want to mess with that. I mean, look, I don't know. Do I care? No, but maybe you do. And now might be a time to sell your Tesla stock, because you got $1 million gain in there and you don't want to see that $1 million gain being taxed to you in the future. So you sell it to use some of your holdings to offset that. Going back to my lady with the Fidelity Growth Fund, maybe she has big capital loss carry forwards. She does not. But if she were to do that, maybe we start reducing some of her holdings. All right, now before you start lickety-split, start selling stuff en masse because old Josh told you so. Now, let me go back to the lady. She got $500,000 in capital and unrealized capital gains. The Fidelity Growth Fund is a wonderful portfolio. All right. I mean, she's going to get a hit with taxes, so we'll find other things that are trading at a loss. But if she's leaving it to her kids, and why would we sell that? We wouldn't. Why? Because it has a step up in basis. So if she dies tomorrow, let me get my thing here again. So we got $500,000. That's her cost basis. All right. So she got a cost basis of $500,000. The portfolio grew to $1 million. So she got 500,000 as her cost basis. The portfolio grew to $1 million. I'm sure you can see that, right? Which means she has $500,000 of net unrealized appreciation. And NUA is something different. If you're thinking from an account perspective of a 401k, I'm not thinking NUA. That's something different. I've never been a big fan of that. Anyway, maybe some other video will get into that. Net unrealized appreciation. So she has $500,000 of gains that she hasn't paid tax on. Let's just say she got hit by the proverbial bus right now. She went to check the mail, and the mail lady lost because it got icy here in Georgia yesterday, and she's dead. Sad to say. Or even worse, she fell off a ladder because she did not listen to me and said she got up on the ladder, was taking down Christmas tree lights. Don't do that. So she got $500,000 is her cost basis. $1 million is her gain. $1 million is her holdings. That $1 million then transfers to her heirs completely tax-free, because of step up and basis rules, which means her heirs receive that $1 million tax-free. So if she were to make a horrific mistake and sell this puppy now because she didn't like Elon Musk, and then she died tomorrow, all those gains are taxed to her, where she could have just waited one day and now she's dead. But her daughters would be very, very upset because they got to pay tax on that. They could have got that tax-free. I mean, her mom had to pay tax on that, where they could have got that tax-free. Secondly, capital losses don't go forward. So step-up basis rules applies to appreciation, but also what that means is if you carry forward on the date of death your valuation, you don't pay your heirs don't pay tax on any gains you've had outside of an IRA. But if you have losses, they lose those too. And so you got to sell your losses, because if you die with losses, my friends, they don't do anything for your heirs. They don't. It's horrible. I got $100,000 of unrealized losses, and I was paying all these gains over years. But you should have been selling those losses to offset those gains, which would put more in your accounts to leave to your heirs. Or at least give your gains to charity, but don't sit on losses, because they don't carry forward to you. All right, they don't. So it works on both ways. The step up and basis works where whatever the date of death valuation is, what your kids inherit that property at. And so if the date of death valuation is $1 million and you paid for $500,000 for it, they inherited at $1 million, which means it's completely tax-free. If the date of death valuation is $400 and you paid $500 for it, they inherited at $400, which means that $100,000 loss is just gone. It's just gone. Don't do that. It's gone like a Nixon tape. I don't know if you ever heard of John Hyatt. He's kind of like an Americana singer. Oh, such a wonderful, wonderful guitarist and singer. Is gone like a Nixon tape. Is that what he called? One of his songs. I can't remember, but oh man, every time I think it's gone, I always think of John Hyatt. Hiatt. Wonderful, wonderful musician. All right. So that's just remember that capital losses don't carry forward with you. They don't. Capital gains, if you die with them, they don't. There's no capital gain tax due to your heirs. All right, so I've been yapping. I spent a lot of CO2, and thankfully right now, because it's cold here in Georgia, thankfully we are on natural gas. How I love fossil fuels. I can see a bunch of people say, "Ooh, would not be able to warm my house without the beauty of natural gas." So other than keeping a spit CO2 on you guys, anything, thoughts, questions, concerns that you want to have here? Last request. Anything you buy, if you buy it through my Amazon link, it helps old Josh and our 4 kids. A shameless plug to feed my children. But if you do go through Amazon and you'd use my link, it does pay me. So if you're going to buy something on there, you're going to buy a new car, buy it through Amazon. If you do it through my link, it'll pay me. So if that's the way you want to support the podcast or the YouTube channel, I much appreciate that. Don't forget my book. I did change the cover. It is still out there. You can download it for free, as I always say, on the website. You just got to put your email in there, and I'll put you on the subscriber list. I usually send 3 emails a week or so. If you want to go on Amazon, it's $4.49 on the Kindle. Kindle Unlimited is free. And how much is it on the paperback? I can't remember. $5.99, I think. I did notice a typo. Somebody, I don't think anyone here, my man Francis actually did show me a typo on the book, which kind of ticks me off because I thought I looked at it. And I'll show you what I'm talking about. It's on page 21. It doesn't change anything around, but there is a typo on here. So if you're using my book, do that. But just remember right here, there's a typo on that chart. That's page 22. That should say 44,000 right there. That should say 44,000. And this will right here is wrong as well. Now the notes tell it like it is. That chart, I screwed it up, and I didn't want to change it on Amazon because that just puts everything back like it's a new book, and all the reviews I have don't carry forward. I did change it on Kindle, but if you're reading this book and you find a typo, man, let me know, because that was, I don't know how that slipped. I'm pretty adamant on book proofing, and I missed that one. So you got it, Monty. But anyway, you can buy that book. It's on Kindle and Amazon. Of course, I got my other book too. which I don't know where this is. I got a mess in here, my friends. Man, I got my other book. It's more for younger folks, like my man Joe. I'm getting to you, Joe. I'm working on that stuff here. I was thinking about actually working on it today. So, Joe, if you're still online, I am working on your stuff, and I can't find my other book because I live in a pit in my office here. Appreciate y'all being here. As always, don't forget to subscribe. A thumbs up always helps me for sure. Comments, questions. Go to the blog at heritagewealthplanning.com, and we'll see you all next time. Happy tax planning. Thanks now.